a market is healthy, you should be able to answer one simple question without hesitation. What is the price? Not roughly, not depending on where you are, not unless you need delivery, just the price. And when you can't, answer that cleanly anymore when the same metal trades like it has multiple price tags depending on location, delivery speed, and form. You're no longer watching a normal market. You're watching a market under stress. That's why this headline Shanghai silver pushing toward $90 matters, even if the number prints differently depending on the contract, the conversion, or the premium. Because the real story isn't whether a single tick hit $90, the real story is that something is off in the market. And the off part is showing up in the place where industrial demand is the most intense and where physical tightness shows itself early. China, stay with me until the end. Because this is one of those moments where watching the chart can actually make you miss the truth. When a market starts to fracture, the chart is usually the last place the fracture becomes obvious. The first place it shows up is in behavior premiums, delivery terms, inventory reluctance, and the quiet urgency of buyers who can't afford to wait. And if this is a real crack forming, the next phase doesn't arrive as a polite trend upward. It arrives as a repricing, event fast, disorderly, and confusing to anyone who's only watching the headline spot price. Let's define what something is off. Actually means in a serious way. It doesn't mean conspiracy. It doesn't mean a secret cartel flipping a switch. It means the market's normal balancing mechanisms are weakening. In a healthy commodity market, arbitrage keeps prices aligned. If silver trades higher in one venue, traders buy the cheaper price elsewhere, move supply, and close the spread. That's how one global price is enforced. But arbitrage only works when the system can actually move metal smoothly when financing is available, logistics are reliable, deliverable inventory exists in the right form, and the time delay between buying and delivering doesn't create unacceptable risk. When those conditions weaken, the market stops being one pool and becomes multiple pools. One pool is paper silver, futures, contracts, ETFs, synthetic exposure. That pool can be huge because you can trade billions without moving a bar. Another pool is physical silver, deliverable metal in the right form, in the right location, on a timeline that industrial buyers can rely on. That pool is much smaller and more constrained. A third pool is the local market reality. What buyers in a region actually pay when they need silver now. Not in theory. In calm times, these pools stay linked. In stressed times, they separate. And separation is exactly what creates the kind of Shanghai premium stories people are seeing. Shanghai pushing toward $90 isn't just a number. It's a signal that the physical market is pricing something. The paper market is not fully reflecting tightness, urgency, and reduced flexibility. Now, why would Shanghai show this first? Because China sits right on top of industrial demand. China is a manufacturing and processing hub for solar, electronics, and a huge chunk of the global supply chain. When Chinese buyers step into the market aggressively, it's rarely about speculation. It's often about procurement, about securing supply, about making sure factories don't slow down, about protecting production schedules. In other words, when Shanghai trades at a major premium, the market is telling you something. Real buyers are paying up for access, and access is the real story. Here's what most Americans miss about silver. It's not just a precious metal. It's a strategic industrial conductor. Silver is used in solar panels for conductivity and efficiency. It's used in EVs and modern vehicles across electronics, sensors, power systems, and connectivity. It's used in data centers, advanced computing, and high-performance electronics. It's used in medical applications. It's used in defense and aerospace systems. And much of it is consumed and dispersed into products in tiny amounts that are not economical to recycle at scale. That means silver demand isn't just a buy and store demand. It's a use and lose demand. A drain dot. Now combine that with the supply side reality. Silver supply is not elastic. It doesn't respond quickly when prices rise. New mines take years to develop, or grades decline. Mining costs rise, permitting and regulations slow expansion. And a significant portion of global silver production is byproduct supply from mining other metals. That means silver output depends on broader mining economics, not silver prices alone. So when demand accelerates, supply doesn't jump. The system leans on inventories, the buffer stock. But buffers can shrink quietly, and when buffers shrink, the market's ability to hold a line weakens. So what creates a sudden premium surge or a local push toward $90? Usually, it's a mix of three conditions: a tighter physical market, a rise in urgency, and a breakdown in easy arbitrage. Condition 1. Physical tightness. Deliverable supply is thinner than usual. Inventories are not rebuilding. Sellers become reluctant. Condition 2. Urgency. Industrial buyers need supply continuity. They can't pause production. They can't risk delays. If they sense a tightening market, they shift from just-in-time buying to just-in-case buying. They lock supply early. They pay premiums. They pull future demand into the present. That makes tightness worse. Condition 3. Arbitrage. Friction. Even if a trader sees a price gap, moving metal is not instantaneous. You need financing. You need shipping. You need the right bar form and quality. You need time. And in a stressed market, the risk that conditions change before you deliver becomes real. That's why gaps can persist. The risk-free trade becomes risky now. If you're wondering how does this relate to the US, this is where the value of this video really lands. Because when a commodity market fractures into multiple prices, it often signals something broader: a tightening of global supply chains, a resurgence of inflation risk, or a rising level of financial stress. Silver sits at the intersection of all three. That's why it's such a sensitive signal. If silver is tight physically, it can pressure costs for industries that rely on it. Solar deployment, electronics production, energy infrastructure, these are not small categories. If costs rise, some of that cost eventually gets passed through the supply chain. It becomes part of the broader inflation picture. Even if most people don't connect silver to inflation directly, if silver is being bid up aggressively as a hard asset, it can reflect shifting investor psychology, more demand for insurance assets as people worry about debt, currency stability, and policy volatility. Silver is smaller and more volatile than gold. When silver moves, it can move hard. That's why a local premium can become a global signal. Now, here is the part that matters most for retention and understanding. What happens next depends on whether the market is entering a paper-led phase or a physical-led phase. In a paper-led market, price can spike and then fade. Speculators drive the move. Physical demand doesn't tighten meaningfully. Premiums don't stay elevated. The market cools. In a physical-led market, the sequence is different. Premiums stay firm even when paper price pulls back. Delivery stays tight. Buyers stay urgent. The market's floor rises because real demand isn't letting go. That is the phase where price can stop being negotiated and start being dictated by availability. And that is the phase where markets surprise people. Because when physical leads, the move isn't a smooth staircase, it's a jump. Now, you might be asking, if Shanghai is pushing toward $90, does that mean the US price is about to jump there too? Not automatically, but it does mean you should watch for the signs of contagion. Markets transmit stress through behavior. If other regions begin showing rising premiums and tighter delivery, the split widens and global price is pressured upward. If Shanghai's premium collapses quickly, it may have been a temporary squeeze. The point is, the premium itself is the signal, not the headline. So what should viewers watch? Watch whether physical premiums remain elevated even when spot price cools. Watch whether delivery timelines stretch or remain tight. Watch whether major buyers appear to be locking in supply. Early watch whether price moves become more discontinuous, sharp jumps, quick recoveries after dips. Watch whether the market starts behaving like it's short of now supply, not just future supply. Because the tightest markets are not the ones with the highest prices. They're the ones where you can't get the product easily at the stated price. Now let's address the skeptic point head-on. Could this just be a local distortion? Yes. Currency conversion, taxes, contract structures, and local factors can amplify prices in a particular venue, but that doesn't remove the signal. The signal is that the market is displaying stress in a place with heavy industrial demand. If the global system were loose and abundant, those premiums wouldn't persist. The fact that they can appear at all is a sign the market is more fragile than many assume. And here's the final piece. the one that ties everything together and explains why the market may not be ready. Silver is a small market, with slow supply response and rising structural demand. It does not take much to create a split. Once a split forms, it changes behavior. Behavior tightens the market further. Tightness forces repricing. Repricing attracts attention. Attention increases demand. Demand widens the split. That loop is how quiet tightness becomes panic mode. So Shanghai pushing toward $90 is not just a clicky line. It's a warning that the silver market may be entering a phase where one global price becomes harder to maintain handwear. The real story is not the chart, but the plumbing underneath it. Because when a market stops behaving like one market, it's telling you something fundamental. The system is losing flexibility. And when flexibility disappears, the move that follows doesn't ask permission. It happens fast, and it punishes the people who waited for the headline to confirm what the behavior was already saying.